how does your tax bracket really change in retirement? And I'm gonna poke at that a little bit, because the way saving for retirement used to work, like most of the time you had a 401k or some sort of pre-tax retirement plan that you could put money in from your paycheck before it got taxed at that period,
Right. Yep.
and dump it in there. And the narrative goes, hey, you save this, you don't take the tax hit now while you're earning the high level of income.
Yeah.
And then you wait until you get to retirement, and then your tax rate will be lower.
I have heard that saying.
Right?
Yes.
You heard that? I'm going to tell you the reality of what I generally see is that doesn't happen.
Oh, really?
Yes.
Oh, wow. Okay. I didn't know
Okay.
that. So explain. Tell us more.
So I feel a little bad, because that narrative has been going on for decades, and I would say it's changing now, because now plans offer something called a Roth 401k, where you get taxed now, and then when you take it out in the future, it's not taxed again in theory, right?
Okay. Yeah.
I don't know if they'll ever change the tax code on that, but at any rate, that right now that's what we know.
Yeah.
Those are becoming a lot more prevalent in retirement plans now, versus when you got your first job at 22 years old or whatever it was, and you started saving pre-tax. Those are a lot more prevalent and available options now. But the one thing that retirees sometimes get surprised by is, hey, my income tax rate is still really high relative to what I thought it would be.
and
so,
why is that?
well, sometimes it's because they had good behavior. They saved a bunch of money, and they have
Okay.
a portfolio that's
Okay. So they're in trouble even that they did the right thing.
That's right. Or they built up a really big retirement account because they just did the discipline over a long period of time, and they have more money than they thought they would have that they have to take out.
Okay.
So sometimes there's that. The other thing is, especially in the US right now, it's, the focus is on lower tax rates, but at some point, you hear the narrative of, how are we going to pay for this deficit? Like, how are we going to start closing that gap? And our tax rate's going to go up. And so that could always be the lingering surprise out there in the future. But really, really, to come back to it, capital gains taxes, to think about those, think about your what your expectations for tax rates are, because they may not be different than when you were working at this point. So,
Okay.
but the things to think about, let me hit on capital gains a little bit. They're good in a way. Like, I know I might get some listeners here that are like, I hate paying taxes, and I get that. Like, it's painful. It's like you see your money just leave. But sometimes when you need money out of your portfolio, if it's done really well and you've made money, you have a liability there if you need to take it out. And if you're going to need to spend the money, you're going to have to recognize, hey, I made money on this that's now subject to tax. And so if you need a big chunk out of your portfolio, figuring out how you can take that out efficiently is sometimes a good thing to think about.
Okay, and maybe talk a little bit more about what you mean by that, like the liability. How does that offset? Like, tell us a little bit more about what that means and what that looks like for clients.
So let's just use a round number. If somebody comes to me and says, I need $50,000 out of my portfolio, and they want to maintain the balance that it has today, and the portfolio is doubled in size, meaning half of it's taxable, half of it's unrealized gain.
Okay.
If they kept it just very simple, to get that $50,000, half of that essentially would be capital gains. So $25,000 would be subject to capital gains taxes. So if they need $50,000 absolute, because that's what the bill is coming due,
Right.
they're going to need to take more than that out of the portfolio if they don't have the cash to pay the taxes.
Okay, got it.
And so sometimes they're like, oh, I only took 50,000, and then I got to April and they're telling me that I owe $7,000 in taxes on it. And it's
Okay.
like, how'd that happen? Well, you had a $25,000 realized capital gain to get that dollar amount out of your portfolio.